All right, hello everyone. Good afternoon, and welcome to the May installment of our Restoring Neighborhoods Task Force webinar series. My name is Nathan Park here with the National Housing Conference, and today we are really excited to have Lori Goodman presenting with us. She is the Vice President at the Urban Institute and co-director of its Housing Finance Policy Center. With over 200 journal articles published and a wealth of experience and expertise, we are honored to have Lori present on findings regarding cash out refinances from the Housing Finance Policy Center. Before we get into things, just some technical information. We are really hoping that everyone is excited to engage in this conversation and are looking for your participation. So if you have questions that come up throughout the webinar, please feel free to ask them. You can enter them into this question box on the right of your screen. And after Lori finishes her presentation, we will have a period to go through those questions. Additionally, there will be a link to view the recording of this presentation and the ability to download slides, all both sent out at an email to everyone who registered for this. So if that is something that you're interested in, you will get that information afterwards. And finally, if you need any technical assistance, if there's something wrong with the GoToWebinar platform, check out the help menu or visit this link below for more support. With that, I'm going to first turn it over to David Dworkin, our President and CEO here at NHC.
Thanks, Nathan. I appreciate that. I just wanted to give a brief introduction that say how excited I am to hear Lori's presentation on this really critical issue of cash out refinancing. It is, Lori and I have worked together for many years in a variety of different lines on our resumes. And I have to say that certainly when I was at the Treasury Department and today, whenever there's some new research from her, it's always the first thing that I look forward to reading. The work that she's done on the Housing Finance Policy Center at Urban Institute has been groundbreaking in more ways than any of us can really catalog. And so I think it all really does dovetail around this issue of equity. The reason we want people to be homeowners is because we want them to build wealth. And as they build wealth, they both have options available to them, which come with that, which we want, like supplementing one's retirement or paying for your kids going to college or making improvements on your house. But it also, particularly for first-generation homeowners, it is also a vulnerability that there's money out there that other people might be able to strip away. And I think we did see that, a lot of that in the housing crisis. We're trying to quantify that better, working with Urban to do that and come up with policy and underwriting guidelines that can ensure that we don't have the same mistake again. So with that, I'm looking forward to Lori's presentation and turn it over to Lori. Thanks for joining us.
Well, thank you so much. Thanks, David, for the kind words and for inviting me to do this. Cash out refis is a topic that I am extremely interested in. We have, and one that we've done some research on. So let me share some of the results with you guys, and hopefully there'll be a lot of questions. I'm probably going to talk for a little bit under a half hour. Feel free to ask clarifying questions in the meantime, and then we'll just sort of open it up for questions later. So with that, and I'm going to sort of echo the point that David made, cash out refinances are a double-edged sword. It's a tremendous benefit because it allows people to tap into home equity, which is their major source of wealth for most people, but it does present some vulnerabilities, and we're going to see how much worse cash out refis have historically performed. So let me first talk about the need for cash out refis. This basically, what a powerful wealth building tool, home equity is. This shows you, if you look all the way on the far right side of this slide, you see, and this is from the 2016 survey of consumer finances, you see that the median homeowner in the United States has total net worth of around $231,000, of which $100,000 is home equity. By contrast, your average renter has $5,200 in net worth. So basically, no equity, no net worth whatsoever. When you break it down by race, ethnicity, you can see for whites, 277,000 in total net worth, 113 of that is home equity. For Black families, 98,000 in total net worth, 56,000 in home equity. That is a way more than half. For Hispanics, 105,000, 70,000 of that is home equity. So home equity is a major source of wealth for everyone. It is a particularly major source of wealth for Black and Hispanic homeowners. So with that, I want you to realize that sort of cash out refis are not the only technique to leverage your home equity. HELOCs, it is the largest, with about 8.6% of homeowners with an active home equity mortgage. HELOCs are next at about 6.9%, and second or third mortgages are about 2.6%. That is 2.6% of homeowners have second or third mortgages. So the numbers are relatively low. If you go back to 2007, you can see they were much higher. About 14% of all mortgages were cash out refis, and another roughly 12% had HELOCs, and another roughly 6% had second or third mortgages. So the leveraging of home equity was much greater leading up to the financial crisis than it is now. Even so, the numbers are not insignificant. The one thing that is not on here is reverse mortgages, which is very tiny, but the Survey of Consumer Finance does not include those numbers. So I think one interesting question is, how does this differ by age? And what you saw on the previous slide was all homeowners. What you see on this slide is those 65 and older. So just to refresh your memory, for all homeowners, 8.65% of active mortgages were cash out refinances. It is 7.71% for seniors. HELOCs, not too different, 7% in both cases, and second or third mortgages, again, between 2.5% and 3%. So sort of seniors accessing their home equity does not look significantly different from the population as a whole. Now, what's very interesting is when you look by how did you choose to take out home equity? Was it a HELOC? Was it a cash out refinancing? Or was it a second or third mortgage? What you find is that those who took out HELOCs are by and large much more affluent than the average, whereas those that took out cash out refis or second or third mortgages are somewhat less affluent than other homeowners. That is, if you recall from the first slide, your average net worth was $231,000. For those who took out HELOCs, it was $471,000. Cash out refinancings, $203,000, a little bit below the average, and second or third mortgages, $158,000, well below the average. When you look at the housing net worth, on average, the median housing net worth was about $100,000. It's way above that for those that did HELOCs, a little bit below that for those that did either cash out refinancings or second or third mortgages. So I just want to point out that there are 3 different extraction channels, of which cash out refi is the largest, followed by HELOCs, followed by second or third mortgages. Second or third mortgages are reasonably small. HELOCs tend to appeal to those that are much more that are much more affluent than either cash out refis or second or third mortgages. When you look at this for those 65 and older, you see exactly the same. You see exactly the same pattern. Those who took out HELOCs are on average much more affluent and have much more home equity. Those that did a cash out refinancing or a second or third mortgage are less affluent as measured by net worth than your median homeowner, and also have a little bit less home equity. When we think about the potential for cash out refinancings going forward, I think it's very, very important to point out that the percentage of people that have mortgages now has gone up over time, and the percentage of elderly people who have mortgages over time. And oh my God, I'm on this chart, which is really, really depressing. And I'm not even the bottom line on this chart. But you can see the share of elderly homeowners with a mortgage has gone up tremendously through time. So what this means is you're in this case, I have 55 to 60, 61 to 64, 65 to 69. It means, a huge percentage of these folks are going to be entering retirement with a mortgage payment that they've got to make. And the percentage of those, so for example, the percentage of those age 65 to 69 that have a mortgage was about 30% in 1989. In 2016, which is our latest data, it's over 50%. So the need for cash out refinancings is going to go up in the years ahead. In addition, as you can see from this slide, the median amount of the mortgages is higher than it has been before. So more people are going to be entering their retirement years with a mortgage, and those mortgage amounts are going to be higher. So the need for cash out refinancing is going to be greater than ever before, because the need to tap into home equity through all channels is going to be greater than it has been before. So I think that's something that we need to bear in mind. You hear a lot, we can easily shrink the GSE footprint. Let's just get rid of cash out refinancings. Cash out refinancings serve a very important function. And I do want to point out one thing, because this is going to come up time and time again. Obviously, the reason you do a cash out refinancing is that you want to tap into the home equity that you've accumulated. And I think it's actually very, very interesting to look at how quickly home equity is accumulating by price tier. So this is Black Knight data, and what it does is it shows you this is home price indices by price tier, and they divide the world into 5 price tiers: the bottom fifth, second fifth, third fifth, fourth fifth, and then the highest cost areas. You can see that the lowest cost areas went up the most prior to 2007, came down the most, and then have appreciated the most since 2012, which is when the housing market bottomed. And that appreciation potential of the lowest price tier, where supply is the most constrained, versus the highest price tier, is very, very substantial. So, cash out refinancings, are particularly appealing to those, again, who are lower wealth, lower housing values, and the value of that housing has gone up very rapidly. So with that, let me actually talk about cash out refinance performance and what's happened to performance through time. So this is actually a little bit busy slide, but I think it's a very, very interesting slide. What we did is we looked at Fannie and Freddie loan level credit data. So this is full documentation, fully amortizing mortgages. We only used 30-year mortgages. And what we did is we compared sort of characteristics of purchase loans versus those where they did a rate term refi versus those that they did a cash out refi. And I want you to notice a few things. First, if you compare rate refis to purchase loans, what you find is that rate refis have much less risky characteristics than purchase loans. They have lower loan-to-value ratios. They have similar FICO scores. That is, the average loan-to-value ratio on rate refis is 70 versus almost 80 on purchase loans. They have lower debt-to-income ratios. Overall years 32% versus 35%. They have similar FICO scores, and they have a higher owner-occupied percentage. By contrast, cash-out refis tend to have similar risk characteristics to purchase loans. They're worse in some areas. That is, they have lower loan-to-value ratios and a higher owner-occupied percent, but they also have lower FICO scores in a lot of years, and similar debt-to-income ratios. So cash-out refis, your average FICO score is 725 over all years versus 741 for purchase loans. So again, rate refis have less risky characteristics than purchase loans. By contrast, cash-out refis have roughly similar characteristics overall. They're a little bit better in some dimensions, a little bit worse than in others. When you look at performance, it does not look at all the same. So this picture shows you performance, and what you see is that in all issue years, cash-out refis have higher default rates than either purchase loans or rate term refis. So, and by a not insubstantial percentage. So cash-out refis tend to perform the worst. And then you're thinking, well, gee, maybe it's characteristics. Maybe FICO is just so important, and cash-out refis tend to have lower FICO scores. Maybe that explains it. If you look at this picture, if you look at this table, what we show you here, this is actually for FICOs less than 700, and then we divide by LTV buckets. So let's just pick an LTV bucket. Let's pick 2006, 80 to 90 LTV, and again, these are all less than 700 FICOs. What you see is that purchase loans had a 22% rate of ever going 180 days delinquent. Rate term refis were 24%, and cash outs were 27%. If you look at the over 90 category, 26, 27, and 39%. So again, what you see is cash out refis do worse controlling for characteristics than either purchase loans or rate term refis. In addition, not only do they go delinquent at a higher rate, but they also have higher loss severities than either purchase loans or rate term refi. So again, that black line is the cash out refi line. You can see severities are much higher on cash out refis than they are on either purchase loans or rate term refis. And then if you put it all together, you see they have higher loss rates. So this actually shows you the loss rates, which is actually the chances of going 180 days delinquent times the probability that you liquidate times the loss severity if you do liquidate. And you can see that cash out refis perform worse than either purchase loans or rate refi. So for example, in 2006, purchase loans had losses of 3.2%, rate refis had losses of 4.6%, and cash outs had losses of 6%. Now you're probably thinking, gosh, all those numbers sound really, really low. That's really low for 2006. Remember the data that we're using for this. This is Fannie Mae and Freddie Mac, full documentation, fully amortizing 30-year mortgages. It doesn't include any non-traditional products. It doesn't include any of the interest-only loans or the negative amortization loans or the 40-year loans or the loans with short reset periods. This is just fixed rate, 30-year, full documentation, fully amortizing. But it's actually so we're comparing apples to apples to apples, and what you're seeing is the increased riskiness due to cash out refis. So, on one hand, they're really, really important. They serve as one of the few ways that less affluent people can tap into their home equity to meet emergencies where you need money for a specific purpose, be it for your home or to meet medical expenses. On the other hand, they do perform much worse, which brings us to the question, should we worry? So when you look at this chart, your answer would be, oh my God, of course we should worry. Look, almost 80% of the refis that are being done now are cash out refis. That is, the borrower is taking out at least 5% higher loan amount in the new mortgage than they had in the original mortgage. And then the last time you had this kind of percentage was 2005, 2006, 2007. Shouldn't we worry? Shouldn't we worry? Shouldn't we worry? But then when you actually say, well, wait a second, how much are they actually taking out? What is the total cash out volume? Which you can see right here. It's just a dramatic difference. So you can see that in 2006, people were taking out cash at the rate of about $84 billion a year. Now it's at the rate of around $15 billion a year. I'm sorry, 84 billion a quarter versus about 15 billion a quarter. So just a huge, huge difference in terms of the amount of cash out that is being done. So people are cashing out lower amounts now than they were prior to leading up to the financial crisis. We're going to see, because the maximum amount you can cash out is a lot lower. And I just want to point out that not only is there less cash out in absolute terms, but there are a lot of other differences in the mortgage market between now and then. So this is sort of a reminder what was going on in 2001 to 2007. And what I did is I looked at securitizations. I looked at non-agency securitizations, prime, Alt-A, subprime, and option arms. And what you see from the top of this slide is that FICOs were almost absolutely constant. That is, if you didn't trust me on the numbers, you'd think I had just drawn a straight line across the page. But then you look at the percent of interest-only loans, and you can see that in prime arms, the percentage of interest-only loans had gone from 22% in 2001 to 92% in 2007. The percent of Alt-A interest-only loans from 22% to 85%. And in the subprime ARM market, you had basically gone from nothing to about 19%. And oh yes, you had the development of an option ARM market, which allowed for negative amortization. Another common product was piggyback seconds, where you got a 90% first mortgage and then a second for most of the balance. And you can see that the percentage of piggybacks went from almost nothing in 2001 to as much as 47% for Alt-A ARMs and 20 to 30% for other products. You look at the percent of 40-year mortgages in 2006, 2007. They went from almost nothing to about 28% of the subprime market and about 22% of the option ARM or neg am market. And then you look at the full documentation percent. In subprime, it went from about 73% to 57%. In prime, it went from 60% to 22%. And in all day and option arms, from about 30% down to 10 to 15%. So when you think about the period in which people were taking out a lot of cash out refis in 2005, 2006, 2007, you can see that cash out refis were not the problem, or at least were not the entirety of the problem. You had a lot of non-traditional lending products, which contributed greatly to the riskiness of a product that is already in and of itself more risky than either purchase loans or rate term refi. So you had you had a combination of circumstances with products that would not be allowed today. Almost all of the products I've shown you here, low documentation mortgages, 40-year mortgages, interest-only loans, none of that would, they would all fail the qualified mortgage rule. This just shows you cash out refis by product, and you can see cash out refis by product are actually interestingly largest in the VA market at this time. They're bigger in VA mortgages than they are in FHA or in Freddie or in Ginnie mortgages. And unfortunately, the data on this isn't available for Fannie mortgages. Fannie doesn't break out at origination cash out versus other refis. But it's interesting to see how prevalent it is in the VA market. That said, when do you see a lot of cash out refis? You tend to see a lot of cash out refis when there's a combination of circumstances. The first is that the rate incentive is very, very low. That is, people don't have an incentive to do a rate term refi. So you see relatively few refinances, and in a world in which there are relatively few refinances, a higher percentage of those are going to be cash out, because because if I can reduce my interest rate from 5% to 3.5%, I'm just going to do a rate term refi. But if I already have a 3.5% interest rate and I'm looking to refinance into a 4 or 4.25% interest rate, the only reason I'm going to do that is if I want to take out cash. That is, the refi doesn't make sense under any other circumstances. So you can see that the cash out percentage is very high when the refi incentive is low. And the refi incentive is low now because there are so many borrowers that have very, very, very low rate mortgages. You'll also notice from this slide that cash out refinances dominate when there's a considerable amount of home price appreciation. If I've got equity that I can take out, I'm much, much more apt to do a cash out refinance because I can take out more equity. If I can only take out a very small amount of equity, it may not be worth the hassle factor. So you can see that cash out refinances dominate when there are periods of home price appreciation, which makes sense. And think about what I told you earlier in this, that home price appreciation was the most robust since 2012 at the very, very lower end of the market, where basically cash out refis are going to be their main source of taking out cash. They don't have access to the home equity line of credit market, although that may have more favorable rates to them. And again, cash out refis dominate when there's very little interest rate savings on the refi. Sort of corollary of the point I made earlier. When you look at the ratio of the old rate to the new rate, again, when the old rate is very close to or above the new rate, there are relatively few cash outs. There are a relatively high percentage of cash out refis because it's the only reason to do the refinancing at all. So then we come to the question of how is now different than the period 2005, 2006, 2007. So first, we don't have any of the non-traditional products that we talked about earlier. There are no interest-only loans. Piggyback seconds are a lot harder to get. 40-year mortgages are gone. Almost everything is full doc. People are leveraging a lot less. That is, the cash out volume is very, very low by comparison. And Freddie, Fannie, and FHA all have very strict limitations on cash out refinances. Remember, you could do basically 100% cash out in 2005, 2006, 2007. Now FHA has an 85% limit. You got to be an owner-occupied property, 600 credit score or higher, no more than one late payment in the last 12 months. Your existing mortgage has to be at least 6 months old. Your debt-to-income ratio has to be below 41%. And Fannie and Freddie have an 80% limit on one-unit owner-occupied, 75% on 2 to 4 unit owner-occupied, 75% on one-unit second homes or investment properties, and 70% on 2 to 4 unit investment properties. You have to have owned the property at least 6 months prior to your cash out refi, and you have to otherwise qualify through their automated systems, desktop underwriting, or loan processors. So basically, there are maximum limits on cash out refis that were just simply not there in the 2005, 2006, 2007 period. Now, the one place that actually did have limitations on cash out refis was Texas. Interestingly, Texas was the only state that explicitly limits borrowing against home equity. A 1997 constitutional amendment limited home equity loans and cash out refinancing by restricting overall borrowing against home equity at 80% or less of the home value. So in Texas, you could never borrow more than 80% of the home value. There is some recent research from the Federal Reserve Bank of Dallas that actually looked at defaults on homes that were in Texas versus homes that were just across the border that looked similar in all other respects. And they basically concluded that the probability of default was about 1.5% lower overall from 2007 to 2011 because of these rules. And the effect on non-prime mortgages was even greater, on the order of 4 to 5%. So basically what he did was, by looking at these discontinuities at the Texas border, he found that the default rate on mortgages within a short distance of the border were 20% lower on the Texas side of the border than on the other side of the border. So certainly restrictions on home equity extraction make a big difference, and those restrictions are built into the current environment. So bottom line on cash out refinancings is, yes, they were very, very detrimental in the 2005, 2006, 2007 period. And they were particularly detrimental because they were combined with a lot of non-traditional loan characteristics. All of those are largely gone. Cash out refis provide an important vehicle for people to draw on their home equity. And for many people, that is their only source of wealth that they can draw on. So bottom line, I am actually not concerned about cash out refis at the present time. There are very legitimate reasons to allow borrowers to do cash out refis. They need cash for home improvements, for medical bills. Cash out refis do perform much worse than other refis, but the amount of home equity extraction is very low at the present time. And Fannie, Freddie, and FHA all strictly limit the maximum loan-to-value ratio on cash out refis. So with that, let me actually open it up for questions. Thank you very much.
Fantastic. Thank you, Lori. And just as a reminder to everyone that if you do have questions, please enter them into your little question box and we'll be able to filter through them up here. With that, we'll start with some Q&A. So David, if you want to go ahead and ask.
Sure. Lori, I think it makes a lot of sense that there's been improvements in how we underwrite cash out refinancing. loans, with the levels you talked about, 85 LTV for FHA, 80 for Fannie and Freddie, is that the right level, do you think, in a scenario, not in our current market, but in a more difficult economic scenario? Are those the right levels, or would it be appropriate to have, say, a lower LTV requirement, meaning that, or more restriction, and if you're not taking the money to be used for, say, home improvement or for college education, or the kinds of things that IRAs are allowed to allow you to remove your equity?
So money's fungible, and it's actually very, very hard to prove use, because I can say, if I have a small amount in the bank, but I want to both take a vacation and do a home improvement, I can say, oh, this money is for the home improvement, or this money is for my kid's college education, or this money is for medical expenses. The vacation is being taken over here. So I think it's very hard to tell exactly, what the money is used for, as much as, we would perhaps like to be able to do that. Your question is 85 or 80 the right level? It sort of depends on how much obviously it depends on kind of, if you get a downturn, how much of a depreciation in home prices do you get? And my feeling is that the events of, sort of the Great Recession is not going to happen again in that form. And part of the reason, with the sort of 30 to 33% home price depreciation that we had. And I think the reason for that is that you just had such a relaxation in credit standards, and you had all these non-traditional instruments, and people were just levered to the hilt. And then the minute you got the sort of downturn, it sort of led to almost panic type selling, just because of how levered people were. I think, because again, you had, a lot of people were borrowing at close to 100 LTV. So I think you also had a huge amount of oversupply in the period from 2001 to 2007. That is, we were building a lot more units than the rate of household formation. By contrast, since 2009, we've been building a lot less units than the rate of household formation. So, with a supply shortage, I think even if you get a recession, you're unlikely to get substantial home price decreases. So my answer would be, it may not be the right level for all time, but certainly in an environment with acute supply shortages, I think 80 or 85% loan to value ratio is a reasonable number.
Great. We have a few questions here in the chat box. So first, any data on refis to reduce the interest rate and the number of years amortization? 15-year terms typically have lower interest rates, so by paying the same monthly, one can more quickly eliminate the mortgage. So yes, 15-year mortgages are a great refi product. They allow you to cut your interest substantially. The issue, though, is because you're able to amortize the mortgage in 15 years, and also 15-year mortgages have very low default rates. I love the product. In practice, it tends to be a product for lower LTV borrowers. It tends to be a product for more affluent borrowers because your monthly payments are a fair amount higher. And you almost never see it used as a cash-out refi vehicle. Got it. Thank you. This one is a more technical question, but someone asked, does your analysis factor in additional closing costs, additional basis points required for cash-out refis?
No.
Great.
I wish I had the data. It does not.
All right. And how do you think reverse mortgage could play a role in the older ages carrying a mortgage balance into retirement?
So when you take out a reverse mortgage, one of the most common uses of that reverse mortgage is actually to pay down your forward mortgage and eliminate that payment. And in fact, the only time you're allowed to take out more than like 60% of the value of your home up front in a reverse mortgage is to pay down your existing mortgage. So I think it's a very, I think you sort of in theory, reverse mortgages can be a very, very, very powerful tool to tap into home equity for seniors because, you know, it pays you or it allows you to eliminate your first mortgage, which is a drain on your finances at a time when you're not bringing in a lot of income. So I think, you know, it's a potentially very, very powerful tool, albeit underused, misutilized, and perhaps higher cost than it should be in many cases.
Great. All right, the next question. Your analysis breaks down the information by age. Does Urban have information on mortgages and extraction channels broken down by other demographics such as race and household size?
The answer is we have done that for the senior population. We actually did a paper a couple of years ago where we essentially looked at the over 65 group by race and ethnicity. We haven't done it for everyone. Although it wouldn't be hard to do. It's just, so basically anything that is contained in the 2016 Survey of Consumer Finance, you can break down by age, race, ethnicity, income. You don't have, it's a pretty small data set and you have no geographic information.
Got it. All right, and another question. If this is one of the few ways for low-income people to access more money, what can we do to lower rates of default or provide other alternatives?
So I actually think cash out refi mortgage rates are pretty reasonable. That is, they are only very, very slightly higher than rates on purchase loans. And of course, they're a little bit higher because, you know, Fannie and Freddie do have loan level pricing adjustments on it. I think the issues tend to happen when you can't access, when you're not affluent enough to do a home equity line of credit and rates have risen enough such that a cash out refi is non-economic. But I think cash out refis by themselves are, you know, a pretty economic way of accessing home equity. I don't know if that answered the question. I mean, your other alternative is credit card debt, which is just an order of magnitude more expensive.
Mm-hmm. And then the one final question that is in the chat box. So while I'm asking and while you're answering, if anyone has any last-minute burning questions, please feel free to throw them in there. But this last question reads, can you elaborate on the difference between the 2006 and 2018 cash out refi volume? Is the maximum amount so much lower now strictly because of limits?
The maximum amount is a lot lower now. The maximum amount's a lot lower now. And then you also, most of the cash out refis now occurs through agency mortgages where those limits are binding. If you recall, in the 2005 to 2007 period, cash out refis were mostly in the non-agency market or heavily in the non-agency market. In addition, 2005 to 2000, you had a huge amount of home price appreciation, as you've had since, you sort of basically had kind of steady increases in home prices all the way along. So you were starting at a reasonable level, and then you had home price increases. If you sort of think about more recent history, you had a huge home price decrease and then a home price increase. So it's brought, some people above where they were. So sort of nationally, we're, 12% above the previous high, although it differs by area. Whereas, if you bought a home in 2001, by 2007, you were 50% or something like that above the high. So you just had more home equity to cash out in the 2005 to 2007 period because of a very, very, very prolonged period of home price appreciation. And there were no limits, and you could basically borrow up to 100 loan to value.
Got it. Thank you. And we do have another question that was submitted. This one reads, we have historically seen cash out refinances increase when transitioning from rate term to purchase markets. Have you noticed similar trends and found qualitative reasonings for this?
Absolutely. So let me actually, so if you go back to sort of the recent slides, you can see sort of as rates have risen since 2016, the amount of cash outs is way, and as we've transitioned to more of a purchase market, the amount of cash outs is way up as a percent because, again, the only reason to do a refinance is to do a cash out refinance. A rate term refi doesn't work for many borrowers because they can't actually save any money.
Got it. Thank you. So that seems to be the end of the questions. Did you want to throw on the next slide? I know that if you wanted to plug for people who want to stay connected with your work.
I think I lost my screen. Sorry.
Oh, no problem. Well, we can definitely send out that information along.
Yeah, sorry
with,
about yeah.
The rest of the slides, no problem at all. In which case, Lori, thank you so much for taking the time to present with us today. It was super insightful, and we really appreciate this and the work that you all are doing over at Urban.
Well, thanks again for having me. I really appreciate it.
Of course, anytime. Definitely happy to have you. And thank you to everyone else who was tuned in and who engaged and asked questions and followed along. We appreciate all of your time. Just one last announcement before we sign off. Let me just pull up my screen. So we have our next Restoring Neighborhoods webinar that you all can tune into, scheduled for June 12th at 2 p.m. Eastern. It's going to be a presentation by Cynthia Wong, the Executive Director of Bay Area LISC, and she'll be presenting on the $500 million partnership for the Bay's future affordable housing fund. Additionally, as you all know, the Restoring Neighborhoods Task Force aims to lift up local research, policy changes, and best practices to help us explore connections between housing and other community development issues. At NHC, we want to hear from our members about what's happening in your neck of the woods. So if you have an example of good research, policy change, developments, or more that you'd like to share with us, please feel free to email me at npark@nhc.org. And again, thanks for tuning in, and we'll see you all at next month's Restoring Neighborhoods meeting. Thanks, everyone, and thank you, Lori.
Thank you very much for having me. Take care. Bye.